of GLENMARK Life Sciences. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Soumi Rao. Thank you, and over to you, ma'am.
Good evening, everyone. I welcome you all to the earnings call of GLENMARK Life Sciences Limited for the quarter ended June 30th, 2023. From GLENMARK Life Sciences, we have with us Dr. Yasir Rawjee, our MD and CEO, and Mr. Tushar Mistry, our CFO. Our board has approved the results for the quarter ended 30th June 2023. We have released the same to the stock exchanges and updated it on our website as well. Please note that the recording and the transcript of this call will be available on the website of the company. Now I'd like to draw your attention to the fact that some of the information shared as part of this call, especially information with respect to our plans and strategies, may contain certain forward-looking statements that involve risks and uncertainties. These statements are based on the current expectations, forecasts, and assumptions that are subject to risks which could cause the actual results to differ materially from these statements, depending upon the economic conditions, government policies, and other incidental factors. Such statements should not be regarded by the recipient as a substitute of their own judgment. The company undertakes no obligation to update or revise any forward-looking statement, whether as a result of new information, future events, or otherwise. Our actual results may differ materially from those expressed in or implied by these forward-looking statements. With that, I invite Dr. Yasir Rawjee to say a few words. Thank you, and over to you, Dr.
Thank you. And good afternoon and welcome to everyone on our earnings call for Q1. It's a nice beginning for the financial year for us, with revenue from operations growing at 18.1% to 579 crore. We can attribute this to efforts of our internal team as well as favorable shifts in the external environment. So let me get into some details here. Firstly, the success that we have seen and hopefully will continue to see is based on our diversified and niche product basket. With the internal focus on process improvement and tighter controls on operational costs, hopefully this should help us to continue this growth momentum. Apart from the internal factors, several external factors have also been favorable to the growth, which do include demand revival from the US market. In addition, we see steady traction in Europe, emerging markets, and India. And then we should also mention that there's an improved supply side environment, which has helped us as well, especially on the margin front. Now, looking at the segmental performance for the quarter, we saw, in the last quarter that the CDMO had picked up very well. And that continues, and again, very likely to continue. The generic business also has picked up nicely. Like we said, it's growing from the US, Europe, ROW, as well as India. So the business traction is very good, CDMO as well as generic API. Interestingly, our GPL business has also started looking up from the last quarter, and the demand looks positive for the next couple of quarters. Right? Our external business has also grown, like we said, substantially. So that's on the business side. With respect to R&D, we have added one more molecule to our iron complex pipeline. So that takes our total number of products to 4. We've also added 2 high-potent products, high-potent APIs, to our onco grid, which is now 9 molecules. The total addressable market for these is about 20 billion for the front end. And we've engaged in a fair number of tie-ups with customers as well. On the filings across countries, our filing number stands at 476. So again, to sum it up, it's a strong pipeline. We continue to add more. On CapEx, we expect to close between 150 to 200 crores for this financial year. And a good portion of that will go into Ankleshwar, Dahej, and the Sholapur greenfield. So, overall, we've got a good visibility for the financial year, and with the improved demand and pricing environment, coupled with better input costs, we expect strong growth in the coming quarters. We continue to guide to the mid-teens with stable margins for FY24. I will now hand over to Tushar Mistry, our Chief Financial Officer.
Thank you, Mr. Hello and good evening, everyone. Welcome to our Q1 FY24 earnings call. I would like to briefly touch upon the key financial highlights for the quarter ended 30th June, and then we'll open the floor for questions and answers. We registered revenue from operations of 579 crores for Q1 FY24 with a growth of 18.1% year-on-year. While Dr. Yasir has discussed the growth drivers in his opening remarks, I would like to highlight that the product mix has been trending towards more value-added products, which is helping us deliver quality growth. Gross profit for the quarter was at 330 crores, up 26.6% year-on-year. Gross profit margin for the quarter was at 57.1%, up 220 basis points on sequential basis and up 380 basis points compared to the same quarter last year. There were two reasons for higher gross margins for the quarter. One, the better product mix that we saw in Q4 of last year continued in current quarter as well. Two, we have seen softening of raw material prices, including solvents, during the quarter. EBITDA for the quarter was at 195 crores, up 24.8% year-on-year. EBITDA margin for the quarter was at 33.7%, flattish on sequential basis and up 180 basis points on year-on-year basis. Profit after tax was at 135 crores, a growth of 24.3% year-on-year, and PAT margin for the quarter was at 23.4%. Coming to business performance, external business grew strongly by 17.9% year-on-year. External business was driven by strong growth in regulated markets as well as robust pickup in CDMO business. GPL business also grew by 18.5% year-on-year. GPL contribution to the revenue was close to 34% during the quarter. As mentioned by Dr. Yasir during his speech, we are witnessing a significant rebound in GPL volumes, which is expected to be carried on in the coming quarters of the current financial. Generic API revenue for the quarter was at 504 crores, registering a growth of 13.3% year-on-year on the back of strong growth in the regulated market, supported by steady growth in emerging markets. For the quarter, CDMO business continued strong growth momentum. Revenue from CDMO business was at 46 crores, up 91.3% year-on-year. R&D expenditure for the quarter was at 17.4 crores, which was 3% of our sales. We anticipate R&D expenditure to stay around 3% for FY24 as well. Coming to working capital, the improvement in working capital with working capital days for Q1 24 at 165 days, majorly driven by reduced debtor days. Capex for the quarter was at 35 crores. As Dr. Yasir mentioned, for the full year, we will keep up with our strategy of calibrated capex of around 150 to 200 crores for the year. We continue to remain a net debt-free company, and I am happy to inform you that we have generated strong cash flow of 98 crores during the quarter, which further strengthens on the books as of 30th of June 2023. Overall, we are hopeful of continuing the growth momentum in coming quarters with stable margins, provided the external environment remains conducive. With that, let us open the floor for Q&A. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to two per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The first question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Thanks for taking my question. My first question is on the gross margin trend, the 200 plus basis points improvement that we've seen quarter on quarter. Could you give us a rough breakup of how much of this was probably because of product mix versus RM softening? And also just trying to understand how sustainable this product mix benefit is. RM obviously depends on a lot of other factors, but how should we look at the gross margin trends for the rest of the year?
Hi, Neha. We saw the group good product mix in Q4 as well. And if you see Q4, gross margins were in the range of 54.9%, almost 55%. The improvement in or reduction in raw material prices was not seen in Q4. But the delta that we see currently is purely because of the raw material prices. So that's how one should consider that the better product mix was around 55% and the delta of another 200 basis points is from the raw material softening. Now, this is the current scenario. From an overall perspective for the entire year, we will see as to how this pans out going forward. But as of now, we see some good traction on the lower raw material prices as well as on the solvent prices.
Are we seeing any risk in terms of potentially raw material prices inching up? Or it's fair to assume that we have a fair bit of comfort on where raw material prices are?
So now for the next couple of quarters, I think raw material prices should be very stable.
I'm sorry, sir. Your audio was not clear. Can you please repeat your question?
Yeah. So the question or the answer?
The answer, sir. I think your voice was muffled a little bit. Sorry.
Okay. So we expect the raw material prices to hold for the next couple of quarters based on the visibility that we have. So it should be okay for a couple of quarters. We don't know how the macroeconomics conditions change, and so we'll see. But at least for now, I can say that it will be good for the next couple of quarters.
In that case, sir, what is the reason for the stable margin guidance? Because we did 30%, we have done close to about 33 in the current quarter. Just trying to understand the quarter that we've seen, your commentary, and the guidance that we're giving both for top line and margins.
So there's a mix issue here too, right? I mean, basically we've had very good mix plus the raw material prices have helped, like Tushar explained. Okay. And that, so I mean, if the mix continues to be similar, then I would say yes, it would go up. But I'd rather, bet on the sort of, we'd be probably closer to what we'd seen in Q4, right? With these reduced raw material prices. So I mean, both of them are pulling in the same direction now. But then we are not so sure that the mix will continue to be that favorable.
Understood. Thank you so much. I have more questions, but I'll get back in the queue.
Okay. Thank you.
Thank you. The next question is from the line of Shyam Srinivasan from Goldman Sachs. Please go ahead.
Yeah. Hi. Good evening, and thank you for taking my question. Just two ones on the overall generic API trends, and if you could give us some color from a therapeutic mix perspective. I think cardiovascular still seems to be coming down. So just want to understand how the whole generic piece is, including your own pricing. Will this lower RM costs, will it also eventually 1-2 quarters later, will it impact your pricing power as well? So just want to understand overall generic industry, how are you faring and what is happening in the therapy area mix?
Okay, so let me take the therapy first, right? Again, cardiovascular is very steady, Shyam, right? CNS has done better. And again, that's because of, existing products doing much better. Plus, we've added one new product on the CNS side. It was launched recently, and the post-launch quantities are very good. So the CNS franchise is doing well. On the overall generic I think we've been firing pretty reasonably across the quarters. Of course, in the last couple of quarters, it was Japan and LATAM that had pushed very well. But then this time it was more the US and India, right, that has delivered. So, since it's not really a quarter-to-quarter business, we are seeing a pretty solid demand across, and even we expect Japan and LATAM to bounce back. Plus the so that's the on the generic side. So, of course, we did pass on some cost benefits to customers, right, as a result of CIP processes. So that does, sort of impact the top line there as well. But considering that the demand has been so solid across the markets, we expect the generic numbers to continue to grow.
Understood, Dr. Yasir. Just my second question is just on the CDMO business, right? So again, I know it's volatile and we shouldn't be water, but it's probably driven faster than company average growth, right? So any visibility, I know it's down QOQ, but just want to understand how should we look at the CDMO business when we look forward? Will it gain in terms of contribution overall? And what are some of the projects that have contributed to this growth? Thank you.
Okay. So CDMO, we've got 3 commercial projects, right? And last quarter, we got a big shot in the with one of them getting an additional indication, okay, and that bumped it up very significantly. That is something that will continue. Our customer is pretty confident of, more than doubling their volumes on that one project. So what we have now in terms of 3 commercial businesses, right, will continue to deliver at this level. We had a 4th, project that continues to get delayed because of regulatory filings at the customer's end. But the good news is that, in the last quarter, we've had traction on 2 CDMO projects that have now moved into advanced stages with 2 different innovators. Okay, and we expect that by Q3, Q4, at least one of them will kick in, to a reasonable extent. Right. So, these are recent developments, and we haven't really spoken about these 2 projects earlier. But we expect that by Q4 latest, we should have at least one of them kicking in very significantly. So, apart from the fact that the 3 we have are going to be fairly stable, and from these 2 new ones also, we expect one to deliver. So CDMO will be pretty strong this year. Quarter on quarter, it might vary a little bit, but on the year, we expect CDMO to contribute nicely, 8 to 9%.
Okay, sir. Thank you.
Thank you. A reminder to all the participants, anyone who wishes to ask a question may press star and 1 now. The next question is from the line of Tarang Agarwal from Old Bridge Capital. Please go ahead.
Good evening, sir, and congratulations for extremely strong set of numbers. 2 questions from my side. One, if I look at the growth for this quarter on a year-on-year basis, how much of it is volume-led? One, and second, how much of it is from the set of molecules or set of APIs that you were supplying in the base quarter, and how much of it is from probably new molecules? So that's one. And the second, I believe you spoke about an iron complex compound that you're working with. Is this in addition to one that you already have? And if that is the case, what is the status of DMF filing for the first compound? And how far ahead is your customer in garnering approval for the product? Thank you.
So Tarang, the growth was largely driven by volumes. Okay, there have been some new products introduced, right? I talked about the CNS molecule, right, the new molecule that's in them. Plus, but then both on the generics and CDMO right now, it's a volume driven growth. Okay. As far as old molecules versus new, obviously the old molecules play a very big role because they continue, I mean, they're commercial businesses, right? But the new molecules have also started kicking in. Coming to iron complexes, basically we used to have 3 in the pipeline, of which 1 is already filed, and we are in the query stage for both the customer as well as us. We recently answered the query from the DMF side, just a few days back, and so the customer is also likely to put in their response. And once those responses are acceptable, then we can look forward to a tentative approval. Okay. 2 of the molecules that were in the pipeline are going to be validated before the end of Q3. And then we recently added 1 new molecule which is now in early stages of development. So that's the status on the iron pipeline.
Okay. Thank you. Yeah.
Thank you. The next question is from the line of Bala Murali Krishna from Oman Investment Advisors. Please go ahead.
Yeah, good evening. Regarding CDMO, I would like to know what could be the revenue potential of that fourth project which is supposed to.
Sorry to interrupt. Sir, your audio is not clear. Can you please handset?
Yeah, I think it's fine now. Regarding CDMO business, the fourth project which got delayed since the last 2-3 quarters. And one more project we are supposed to add in Q3 or Q4. What could be the revenue potential of these projects on an annual basis?
So once it matures, it should be around $5 million.
5 million.
So initially in Q4 we may not see that kind of revenue, but once it picks up, the volumes indicated by the innovator, should get us a business of around 5 million.
Yeah, sure. That's it. Thank you.
Thank you. The next question is from the line of VP Rajesh from Banyan Capital Advisors. Please go ahead.
Thanks for the opportunity. Just one question. Our gross margin expanded, as you said, Tushar, by 380 bits. But our EBITDA margin has expanded by about 200 bits. So if you can explain, where that 200 bits is going, is it being invested in the R&D side, or is just the SG&A cost is going up? That will be helpful.
So it was largely driven by manpower and plus costs because we added new infrastructure, right, have also gone up on the operation side. So that's the reason.
Okay, so when you say infrastructure, is it for the new capacity that is coming up regarding that, or is it more with the existing plants or existing operations? Just trying to understand that.
In the month of February, we did introduce Plant 6 in the Dahej. Capacity has been utilized in this quarter. And some capacity even in Ankleshwar was added. And so there's a increase in expenses there as well.
Okay. So is it fair to assume that in the coming quarters, we will get some operating leverage out of these infrastructure investments as well, or these are just sort of regular costs that are going to be there and the impact is anyway coming up in the revenue from these facilities? How should one think about it?
Yeah, so it all depends on the utilization, right? So I mean, once we get that utilization up, right, then we'll get that operating leverage.
Understood. Thank you very much.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Thank you so much for taking my question. Yes, sir. I see that we have increased the capacity addition that we'd planned. I think last it was about 1,800 kiloliters, but there's a new addition that you've added in Dahej and Ankleshwar. Could you give us some color in terms of what businesses, what areas that we're focusing on? Do we have a pipeline that gives us this visibility, for the large addition that we've announced?
So Neha, yes, you picked that up. We do see some benefit in accelerating some of the brownfield projects, right? Because greenfield takes time, and considering that we do have the space and permissions to build out a little more in Dahej and in Ankleshwar, we brought those forward. Okay, it will happen much sooner, and also will happen at a reasonable cost compared to the greenfield. So you're right. We did make those plans and have brought it forward because the demand scenario clearly is going up, and we need to add capacity relatively faster.
Understood. So, has our total capex outlook changed for the next 2 years? Given this, we are already spending on Solapur and we have added Ankleshwar and Dahej. Should we see a step up in spending, FY25, 26?
There should be a little bit, but then, this brownfield expansion is basically happening at a little bit of Solapur's cost in terms of Solapur getting delayed a little bit, right? So like Tushar said, we'll still try to keep, the capex spend between 150 to 200 crores, right? That's still very much the thought process here, right? But we'll see. We've got to, end of the day, we've got to make sure we've got the capacity to service the business.
Understood. And, given that we've had this, CDMO project where you said, we've seen traction, was this ahead of our expectation in terms of what we were looking for the CDMO pipeline? And, do we have enough capacity to service, these additional projects that, the acceleration that we've seen in the CDMO business?
Yeah, see, like we've been saying for a while now, right, that we've got quite a few irons in the fire, right, with respect to CDMO. And it's the customer, right, and their regulatory approach that has basically accelerated this. So initially, we usually do take a bit of a conservative stand with respect to how the customer will make the regulatory filing. But now it seems they want to move faster. So that's why we supplied validation batches in this last quarter for both these projects.
Okay.
And so depending on how things shape up, at least one of them should get regulatory approvals for commercial to start in Q4.
Understood. Thank you so much, sir.
Yeah, sure.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
All right, thank you for taking the question. On the when you look at the business of the generic API business over the next 2 or 3 years, from a growth perspective, you see bulk of the growth will be contributed by our existing set of molecules, or the newer launches will play a more important role?
So Nitin, the new launches are going to play a huge role, right? In terms of contribution, right? In fact, you asked for a 2-year time horizon, but on a sort of 5-year time horizon, our plan at least looks like the new molecules will contribute as much, right? In fact, more. They'd be growing much faster. Because we're starting from a smaller base, right? Plus the market growth itself is, much more. And so we expect the new molecules to contribute very significantly to,
So just to get that right, when you say over the next 5 years, 50%, it's a 50% of incremental sales, or 50% of total revenues with new molecules?
Revenue contribution.
Revenue contribution.
Yeah.
So that's like a very, very sharp, meaningful contribution from some of the newer launches. And in that, is it going to be concentrated on a certain, it's sort of premised on a few specific products, or it's a very broad basket of new launches you're looking at?
It's a reasonably big basket, because we'd explained that apart from the new and the mature products, right, we've also got an expansion basket of existing molecules that are not that big, but then they are expanding much faster, because of newer markets having patent expiry and customers getting added as those patent expiries come through in the markets that are opening up.
And secondly, in terms of onboarding new customers, or what's been your experience been like and when customers, and in terms of new customers that you're onboarding, what's the typical source of supply, API supplies for them in the past before they were approached you?
Yeah, so some of them are second wave filers, so the ones that didn't catch the NCE window, right, and are sort of developing it anew, like 3 years before the patent expiry, right, and want to get in, right. So that's one set of customers, but then we've also had traction from customers who are in the molecule, in the business, but then they're looking for an alternate source. So both those are moving pretty nicely.
And on the latter, if you could just help us understand that a bit, I mean, where are some of these customers largely typically sourcing from when they're looking to switch their sources?
Yeah, so they've got either an existing Chinese source or an Indian source, right? And are looking to, have another source. Plus, sometimes they're not happy with their existing source, so they want to sort of have a backup or even switch completely.
And the last question, in terms of over the last year and a half, based upon how the competitive dynamics in some of the existing molecules have progressed, have you taken a decision to drop any or some of these molecules that you were servicing in the past?
Not really, but then because we've had some capacity challenges for the less regulated market business, we have deprioritized some molecules that don't have a good margin. So there we have been a little, picky in terms of choosing business, right? Wherever the margins have not been great, we kind of deprioritized those and, told the customers that, they need to look elsewhere.
But we haven't had situations where maybe the pricing has come off so much that the molecule is not viable for us to do altogether.
Could you please repeat, Nitin? I didn't catch that.
I'm saying, but we haven't had situations where a molecule per se, the pricing overall has become so sort of unattractive that it didn't make sense for us to continue it. We chose to drop those products. Those situations haven't quite occurred.
No, that hasn't happened.
Okay. Thank you very much.
Sure.
Thank you. The next question is from the line of Ashwini Agarwal from Demeter Advisors LLP. Please go ahead.
Good afternoon, Dr. Yasir and Tushar, and congratulations on a very solid quarter. Just building on what Nitin asked earlier, on the CDMO side, how many products do you have which represents this 46 crores in revenue? Is it only these 4 iron compounds, or there are R&D services on a bench of products where you are doing some development or some chemistry analysis and providing probably proof of concept? Can you give some more color on how deep is this CDMO pipeline?
So Ashwini, firstly, let me clarify. The iron complexes do not contribute to our CDMO. And they will not, because we are working with generic customers on those molecules. So that's part of our generic bucket. These are better molecules in terms of the complexity, and so the entry barrier and even the realization on price and so on is better, right? But CDMO right now is driven by 3 projects, okay, which are not iron complexes. So this 46 crore that you saw this quarter has basically come from these 3 projects. With respect to the depth in the pipeline, I can say now with a lot of confidence that we have quite a few molecules in advanced discussions with innovator players, both on the big pharma as well as the specialty side, of which I mentioned that two have gotten fast-tracked even in our scheme of things, right? Because the customers want them sooner. So those will come in, and then we've got a fourth one that is a fairly big opportunity, but then the customers are, filing in various markets, and so the commercial realization of that fourth project hopefully will come this year towards the end. But even if it does not, these two other projects that have now come in and are moving much faster, one of them will definitely come through in Q4. So when I look at the more advanced projects now, we're talking about 3 already commercial and 3 going to happen soon. That would be 6, right? And then we've got a whole number of, like I said, irons in the fire where we are in discussions with the customers in various stages in terms of supply.
So if you look at the CDMO business on a 5-year basis and you zoom out, do you think we can kind of grow 3x in 5 years?
Your voice is breaking. May I request you to kindly use your handset, please?
Is it better now?
Yes, sir. Please continue.
Yeah. No, what I was asking was that if you were to zoom out and think about the next 5 years, do you think CDMO can grow 3x in 5 years on a 200 crore run rate?
Ashwini, if you recall, I have mentioned this earlier that in a 5-year time horizon, our sort of expectation of CDMO will be we're at about 150-ish crores, right? In 5 years, we expect to go to about 600 crore, and which means that our contribution of CDMO will be much bigger, right? It should be about, from a current 7-8%, it should go to about 14-15% on a 5-year time horizon. I mean, that's looking very doable, okay, based on the traction we've seen in the last few quarters. I mean, last year to now, I mean, in this 1 year, we've had a lot of discussions both with specialty companies as well as big pharma companies. And these are all life cycle management, okay, life cycle management and 505(b)(2) development. We continue to stay focused on that area and not get into, this early phase stuff, because there's a huge amount of attrition in that area. And you really have to do a lot of molecules to make even one succeed. So given my sort of prior experience, having worked in the US in big pharma, right, for a good number of years, right, I know that these are not easy businesses to, make it happen. So much rather work on the life cycle piece and the specialty piece, right? That's the way we are, and really it's the right way to look at it for a company like ours with such a big portfolio, right? And the kind of process development expertise and manufacturing footprint that we have. Long answer, Ashwini, but I mean, hopefully that gives you clarity.
Yeah, no, thank you so much for that. The second question was on the softening raw material input costs or solvent costs. I know that in the past you've said that, look, when solvent costs go up, we tend to absorb them a little because we want to keep customer prices stable. But in a B2B business, there's always the situation where customers want to capture all the cost benefits that a vendor has. So is there a situation where some of the margin uptick that we've seen on account of lower costs will need to be passed on over the next couple of quarters?
It could happen, right? Customers do study, quite a few things, and it's likely that we may have to give away some of that benefit, but certainly we won't do it for everything, right? It's a hard one sort of improvement on the margin side. So it would happen, Ashwini. I'm not saying that it doesn't. That's typical in our business. Right? So, I mean, it would not be, we would not reverse the whole thing.
Okay, great. And last question, just clarification. Tushar, you mentioned CapEx for the quarter was 53 crores or 33 crores? I couldn't hear very well.
CapEx for the quarter was 35 crores.
35 crores. Okay. Yeah, that's all I needed. Thank you so much. All the best, guys.
Thank you. The next question is from the line of Sajal Kapoor, an individual investor. Please go ahead.
Yeah, hi. Thanks for taking the question. Great work on reporting healthy numbers and free cash flow on top of having a net cash balance sheet. So well done. I have two questions. One, the cybersecurity and ransomware incidents have surged globally in recent months. And these criminals are well organized, highly sophisticated hackers targeting profitable companies. So question really is, have we done a detailed risk assessment and an exhaustive penetration testing to identify vulnerabilities in our systems and controls? That's one. And then secondly, what makes us a good CDMO partner and the license to win in this niche area? As a lot of private equity is also chasing this space and competitive intensity is increasing. Thank you.
So on the cybersecurity and on the VAPT, our IT team does carry out the VAPT test on a regular basis. It's a part of the protocol, and that also forms part of our internal ITGC audits. So this is a regular process. It's a pretty robust process that we have implemented internally. We haven't seen as yet any threats on our data in a way. But it's a regular process, and it is something that is very focused on and very high amount of focus is given on that area, not only by the management but also by the board. I'll just let Dr. answer on the CDMO part.
Yeah, so with respect to CDMO, with us, it's important for us to define the space, right? So like I explained to Ashwini, we are staying very much focused on the specialty side and on the life cycle management for our customers. And that's where the products are. Right. Now, one may say that the competitive intensity is high, and I would agree that yes, it is high. But then there are differentiators, apart from cost and capacity, that help us to win business. One big area is the whole business continuity aspect and how that is addressed for the customer. So as long as we are able to give customers that comfort in terms of the business continuity, then you're ahead of the curve in terms of the competition.
And Dr. Yasin, are we investing in business development because relationship is a very key component in the CDMO space? So we have to have that sort of development and investment in building those relationships, those longer-term partnerships.
So again, we are, right? But then my experience again says that, with the kind of depth in the portfolio, right, and our manufacturing infrastructure and our ability in R&D to, do some level of customization for the customer. I mean, this is a pretty strong combination for us to take to the customer. So while contacts are important, right, we are in touch with most innovators anyway, right? So those contacts have been kind of established. In fact, our US office spends more than 50% of its time working only on, this whole, widening the net, basically, of bringing in customers. So this is something we continue to sort of invest and work on.
That's helpful. Thank you. And finally, any update on the US FDA audits? Because I think all our facilities are due for a re-inspection anytime now, right?
Yes, we are overdue. I mean, if you go with the 3-year window, we are overdue. I can't comment for when FDA will come, but whenever they come, it'll be good for us, right? Because you know we can be done with this. But I mean, they also have a big backlog, is what I understand, because of the COVID years. And so I don't know where we sit on their priority list, right? But we are ready.
So we are ready for any surprise audit, and we are confident that we should be able to sail through, right?
Yeah. In fact, we've had other agencies coming and auditing us. So we had Brazilian Anvisa, visit Dahej, and that was in August of last year, and they cleared us. So we've had Anvisa come audit us. We had Cofepris, the Mexican agency, do a pretty detailed audit, which was virtual, but it was a 5-day audit of our Ankleshwar facility. So I guess that, with these agencies also talking to each other, right, there could be some of that too in terms of why FDA hasn't shown up yet, right? I mean, and I plan to know. And I can't speak for, an agency like FDA. They're welcome to come anytime.
Yeah, no, of course, they are. The lens that FDA uses is slightly different, as we have seen in so many cases. And have we got audited recently from PMDA, the Japanese regulator, as well?
No.
Okay, right. Okay, thank you for all the responses and all the very best.
Thank you.
Thank you. The next question is from the line of Tushar Bora from MK Ventures. Please go ahead.
Yeah, thanks for the opportunity and congratulations to management for a good set of numbers. So first, just quick check. There's some seasonality at play, right? So H2 typically is stronger for us than H1. Is that fair assumption?
It's not a quarter-to-quarter business, right? I mean, that's the thing, right? So, I mean, yeah, it could be, but I mean, we hope it is, right? Because we have a good H1, we'll have a good H2 as well. So I hope you're right. But again, we shouldn't read that much into it, right? Into the earlier trend.
Okay. And management has commented for mid-teens growth, right? The guidance is for mid-teens growth on revenue and margins to be stable to slightly higher depending on product mix. Right? Yes. That is okay. And sir, regarding the stake of parent, I think they have to come down from 82 to 75. Is there any update on that side or anything around any M&A or corporate action that you may want to highlight where the process is?
Yeah, so there is a process that is on. Okay, of course, the stake belongs to the parent, right? So they are running the process, right? GLENMARK Pharma is running that process. We are contributing, wherever needed. So yeah, they do have that window, by which it has to dilute down to 75%.
Okay. And where would we be in the process, if you may qualitatively be able to comment?
That's what, so like I said, they are the ones who are driving it, right? And wherever, we are needed to sort of contribute, we are, giving the business view and so on. But really, I would not be able to tell you, right, where exactly things stand in terms of timeline.
And so one quick question on the CDMO business. So given that we are seeing strong traction and guidances for some more molecules to also come in by end of this year, CDMO in general, it's fair to assume would be margin accretive, as in the quarter in which CDMO is strong, our overall margin profile should be trending on the upward side.
Yes,
compared to the others.
That is the case, right? CDMO does have better margins.
So given that relatively we had a subdued last year and this year we've had a strong start, that should also be a factor that will drive in the full year margins as you expect the CDMO performance to continue.
It will have an impact. How much it will have, right? That remains to be seen because it's still in single digits, right? The overall mix also helps. right? So it's not only CDMO that drives the sort of margin on the business side. It does have a contribution, but because it's only like 7-8%, right? So it has that limitation, right? If it was a 20% or a 25% business, then of course, right, it would be very significant.
Which we are expecting that over a period of time, anyway, CDMO business will trend up. Then over the next 2-3 years.
Yeah.
And how many projects would we be in active discussions overall, sir? You mentioned a few projects, but overall the total number of opportunities that we are in discussion and which we feel that we'll be able to qualify in this year, have some relationships.
That's what. So there's a sort of a milestone you have to reach, right? And that's why we are saying with confidence that for 2 more projects we have crossed that milestone, and so we are saying that with confidence. But then the ones where we haven't got to that milestone, we probably should not put a number right now, but there's quite a few in discussion, I could say that.
So it would be safe to assume, sir, say next year we could be potentially be double digit in terms of number of active projects, FY25 sometime?
Double means you're talking 10, 11 projects, right?
Yeah.
No, I wouldn't go that far, Tushar. Okay, I won't go that far. I mean, I like to, we like to be sure and give a reasonable estimate to the market.
Okay, fair enough, sir. Thank you so much. Wish you all the best. I'll join back. Thank you.
Thank you. The next question is from the line of Somil Shah from Paris Investments. Please go ahead.
Hi, sir. Congrats on a good set of numbers. My question was similar to the previous participant that if we see YOY, yes, our revenues have gone up, but quarter on quarter it is slightly down. So any particular reason for that?
Somil, again, right, I mentioned a few times that, right, this is not a quarter on quarter business. We shouldn't be looking at it that way, really. So I think, for the beginning of the year, we've hit it pretty well, right? And, I think, based on what we can see from the demand side, right, things will continue to look good.
Okay. And so, previous year, I think we did on a CDMO side, we did a revenue of, say, 120 crores revenue. And if you say 8-9% of our revenue we are looking, so are we looking to cross 200 crores of business for this year for CDMO?
I hope so.
Okay.
But let's see. But we're definitely trending up, definitely.
And that would be margin accretive, right?
Again, I answered Tushar, right, because it's a relatively smaller contribution to the overall revenue. There's definitely going to be some impact. How much remains to be seen.
Okay. And looking at the raw material prices, so is it safe to assume for at least for next 1 or 2 quarters of our operating margin would remain at similar levels?
There should be a benefit of RM prices for the next couple of quarters, right?
Okay.
So that would help the margin. Look, but the world is a very, different place today, right? Things could suddenly go out of, solvents, for example, is very unpredictable. So I don't know. Based on what we are seeing and how things are trending, on the gas prices and the, crude prices, things should be okay, right? But then solvent prices go up very fast and don't come down as fast.
Okay. That's it from my side. Thank you.
Sure.
Thank you. The next question is from the line of Bala Murali Krishna from Oman Investment Advisors. Please go ahead.
Thanks for the opportunity. I have one clarification regarding dividend. So are you going to continue the same kind of dividend this year also?
No, so that's what we had mentioned earlier, that the surplus cash that we generate will be dividend out during the year or probably at the end of the year. So one should expect high amount of dividend on whatever surplus cash.
Okay. And one more question regarding the previous participant regarding that parent company take. regarding the offloading of entire stake. Do you have any thoughts on that? Or they are going to offload till 20% only?
Nothing that we can comment on that. It's a parent run process. What we are aware is that they have to upload another 8% in the next 1 year's time. And that process, as far as we are concerned, is on. But nothing beyond that we are aware of.
Okay, thank you. Thanks a lot.
Thank you. Ladies and gentlemen, we take that as the last question for today. On behalf of GLENMARK Life Sciences, that concludes this conference. We thank you for joining us, and you may now disconnect your lines. Thank you.